Hey guys, this one's for the option bros out there. I was looking for some earnings trades today and some content to do, and but I'm not really worried about content. But I found something that I want to show Derek if you're watching, Tom if you're watching, anyone that's an option trader if you're watching. It's a cool trick I learned a couple of years ago that I do sometimes. So here we go. Look how good this looks. If you could ever find a trade like this, take it. Okay. What it is it's a double diagonal. I'm calling it a bunt. You're selling a call calendar, or actually you're actually buying a call calendar, but whatever. You're doing a call calendar and a put calendar at the same time. Okay. In this scenario, I'm bullish on DOCU, so I did the call calendar twice. There's twice as much reward on the call side as there is risk or as there is reward on the bearish side. Now, this side also is for somebody that's omnidirectional. It doesn't know which way the earnings are going to go. This probability cone right here, the first hash mark, is at the expected move. The expected move for earnings, the one standard deviation expected move, is to 95 on the upside and to 72 on the downside. So I did a call spread that surrounded 95. The short call was 95. The long call, which expires in the next week, was 94. And on the put side, I did a 74 and a 77. The idea is you're trying to surround generally the number you're trying to get. Really, the number I was trying to get was 73, but for whatever reason, those are the strikes I chose. And the reason I did is because of the combination of the odds that gives me. So look, if I would have just done the call spread by itself is a fine trade. No loss on the upside. If no matter how high it goes up, the trade makes money. If the stock gets the expected move to the upside, it's about $1,000 winner on $151 risk. This is a great trade by itself. Do this trade by itself. It's not an income trade like the loaded dice ones I show you, where you get a credit and where it doesn't have to move for you to make money. This one, you're playing for a move, but it's the move that is most likely to get on the upside. 95 to 100, that's kind of what we're expecting. Even if we don't hold it all the way till expiration, we hold it in, Friday at noon. If it's, at 90, this is a $400 winner. If it's at 105, it's a 400. If it's at 150, you guys get the idea. Okay, so that's a good trade by itself. Well, you can do this as what's called a double diagonal. You can, with the two calls, you can add two puts, a sold put in this week, that'd be the 74, and a bought put in the week behind it. It should be somewhere close to the same strike, but it doesn't have to be the same strike. You can vary it based on your strategy. But this sets up what I would call a very favorable profit loss graph. It's saying chance of profit 100%. There's no such thing as 100% chance to profit. Okay, here's the other thing. This one's bid at $1.62, asked at $1.81. What I always do is, here's the positions of the trades. I always choose bid ask. I can choose midpoint, but it gives you a more realistic feel. It gives you the midpoint, but I choose bid ask, which means I'm taking the worst price at either case, which sometimes you have to do. And if I can make a case work on bid ask, this is on bid ask. So these are getting bad fills or the total retail fills, and it still makes this risk reward. If you can ever do this, this is a good trade. The only thing you don't want is an outlier move to the upside, like more than 40% up. This thing is it's not an income trade because you don't bring it in income, but it's similar to an income trade because if the stock makes a no move, you make money. And if the stock goes to the expected move to the upside, you make money. It goes to the expected move to the downside, you make money. Similar to an income trade, It's like a big white iron condor, but I mean, to me, this is better than an iron condor. All right. So anyway, I'm going to share the, I'll share that trade in case any of you guys are able to get at the market. There's only 50 minutes left in the day. Let's see. But just for shits and giggles, I did that same. I called that trade a bunt, and that was a bunt in DocuSign, an earnings bunt. But I also did just on paper. I did a load of dice, in this same company, and we'll compare and see how the trades do. But this is an income trade. They're both income trades, even though the other one's an income trade that you pay a debit to put on. So it's a different kind of income. I don't know if we could really call it an income trade since you pay a debit. So I'm going to have to figure out what I'm talking about because I obviously have no idea. It's an income strategy. It's just not an income trade because you pay a debit. All right. But I do think you could call it an income or an option earnings trade strategy. Okay, so I just did it on paper, so we'll compare them. DocuSign, I have one of each. Lululemon, I have the loaded dice, the totally long trade, but then I have the bunt on. And the bunt, I thought about calling this the cat. It looks like, but you put one cat ear at the expected move up, the other cat ear at the expected move down, and what could go wrong, right? I mean, you just don't want a huge move up. I mean, a huge beat. So let's see. I did that in Lulu because they have earnings. Then also the same thing in Alta. And then also the same thing. Watch this down here in like OKTA. They had earnings. This was the loaded dice trade, the bullish trade. Received a credit and it's pretty much worked the whole credit now. It's 100% chance of profit. That trade was a winner. But it didn't move. The stock didn't move up enough to get the extra profit. But look at this. You could have also done it. Okay, TA. Here was the double, or here was the diagonal method. Here was the other strategy. Now, this was a single diagonal. This wasn't a double diagonal. I should have done the double diagonal, and this trade probably would have been a winner. But I was just taking a shot at a bullish announcement. The expected move was about 91. I was shooting for 91. It has not turned out yet. Actually, this stock pulled back a little bit. So unless the stock moves up to 91 by tomorrow, and there's not a lot of chance of that, this is only a 17% chance of profit in this case. So this was a loser, but this was these are ways to take a cheap shot at earnings because it's not going to cost that much money. So let's see, we did that a couple of other times. Earnings, the ones that just say earnings idea. Here's an idea. If you don't want to buy stock, you want to do an option trade, take a shot at earnings in Petco. Petco's expected move. These options don't expire until December 20th, but the expected move over the next 2 weeks in Petco is about 662. So you could sell the 6-strike option for 30 cents. It's really overpriced because of the earnings announcement. Okay, but then you would be naked. So that would be a decent way to do stuff. You could make $230 credit right away, 76% chance of profit. The only problem is the unlimited loss on the upside. But when you add in this option, you add in an option you buy, then no unlimited loss, and you can make it where you can make a pretty penny if it goes right to the expected move. It's about a $600 winner on about $500 worth of risk. Anyway, so we'll keep an eye on that one. You can use the diagonals either by themselves, either just the calls to go for a bullish move, just the puts to go for a bearish move, or both together. And here is a both together idea on Alta. Okay, now we pushed all the risk off to the bearish side this time. You can usually choose which side to push the risk off to. This is the same concept as the DocuSign trade. Now, this one is even on both sides. The DocuSign, I did twice as much on the bullish side. Let's see if we could do that just for just for fun, let's do this. Yeah, okay. So now the white line is our old profit and loss, and the green and red is our new profit and loss. So we have a little bit more loss, if we miss it. This is basically a bullish. This is almost like a loaded dice trade because it's a bullish strategy. You just don't want the stock to drop too much. You could call this a loaded dice double diagonal. But if you were bullish and you wanted to go for the bullish, and you thought it was probably going to hit it, boom, then you got a $2,400 winner if it goes to the expected move on the upside. But if it goes to the expected move on the downside, it looks like you should still be able to squeak out a $300 winner, depending on how much volatility drops. I budget 20%, and that's about right. So you still make about $100 on the downside. But you're basically, so I really don't know if this swing down here is wasting money, but it's not really, even though $100 isn't that much, it stops it helps your chance of profit. It helps your chance of profit by doing this four-legged. The other thing that's really good to note about these is on calendars are long volatility. So if you do get a volatility event, it makes your profit more. Now, generally, you do a lot of these trades on earning stocks, and after earnings, lots of times you get volatility that comes in. So you have to budget for that. But you can play these stocks, you can play this strategy on an earnings stock too. If Alta was getting taken over, or not for earnings, if Alta was maybe getting taken over and there's a rumor it was going to get bought for 420, Elon Musk was involved, of course, this would get bought for 420. And you could do a strategy where you sell the 420 calendar spread. And then if that does happen, something like this, you can have a nice, you can have a pretty payday. The thing is, when the announcement is made in a situation like that, volatility will pop and it will give you a bonus. It will move your break even lower, and it makes the reward higher. Because when you're doing a calendar, you're short a call and you're long a call. Okay. Well, the call you're long expires next week. That call is more sensitive to volatility insofar as it has another week left on it. So if you get a pop for volatility, those prices that you're long, the prices that you're long should really expand in a hurry. And so that's kind of what you're playing for. That's kind of what you're playing for also. So you can do this style of trade as an earnings trade, or you can use it in other situations too. All right, so let's see what else. So bunt and Lulu, bunt and DocuSign. The DocuSign was the best looking profit and loss graph. That's a good looking. I like 100% chance of profit. So these types of trades don't really have 100% chance of profit. I need to think of a name for them. They're theoretically they might, but in real life market makers are smarter than this option profit calculator, and they won't quite give you the price you need to make it risk-free. I mean, they know what that is. But what I do is I put on these that are attractive. I take 20% off of it, and that's generally a pretty good estimate. If it's still attractive after 20%, if you want to be really conservative, take 40% off. If it's still attractive after 40%, and even after 40% crush and volatility, still has a 61% chance of profit. It still makes more than $300 if it hits the expected move on the upside, and it makes about $100 if it hits the expected move on the downside, which is about what we budgeted for. So you could definitely come across worse trades to do for earnings trades. I put in for dollar commissions because that's what they charge me at Tasty Trade, dollar per contract. And I figured bid and ask. That, like I say, that's the worst way to figure it. That's the least favorable way to figure it. If I put it in midpoint, it's going to make a lot rosier predictions. I just want you guys to know how I'm figuring out, and I would recommend you guys do the same thing. Put in whatever commission you're paying and put in bid ask just in case you have to pay that much. And that way, and if you don't, when you get there, obviously when you get into your platform, you're going to try to get it. You're going to try to pay, instead of a $263 debit, you might start at 200, you might bid 250 and then, 260, just ticket forward until you get filled. But you don't want to ticket forward too much. At some point, you don't want to pay 700 for that. You know what I'm saying? You want to try to play as close to this number as possible. And if it gets too far from this number, say probably more than like $20 or something, you want to nix the trade. But you have to, that's why you should get option profit calculator, because it can show you all that. You can determine to the penny, what at expiration, if it goes at 158, on the 6th at noon, I'm going to be down 18%. So you can pretty much figure it out exactly. All right. I will put the DocuSign up there and I'm going to post this right now. All right, guys, have a good one.